Good morning and a warm welcome to this ICAS webinar, Materiality Perspectives. My name is James Barber and I am Director of Policy Leadership at ICAS. I have the pleasure of being your webinar host today. Our event this morning will last 1 hour, covering 2 projects on the topic of materiality, with approximately 20 minutes for presentations on each. The first is an ICAS-funded research project, and the second a very recent report from the FRC lab, followed by 10 minutes or so for questions from the audience. I do have to mention that this webinar seeks to present the views and conclusions of our speakers, and that these do not necessarily represent those of ICAS. Before we begin, just a few housekeeping matters to remind you of. You can submit questions at any time through the live Q&A facility, which can be accessed at the right-hand side of your screen. Questions can be submitted anonymously or only to the presenters for this webinar if you wish. We won't identify who questions come from. Please also join the conversation today through the discussion forum, also accessed at the right-hand side of your screen. The forum allows you to comment or discuss with fellow attendees on matters covered by this webinar. We are recording this webinar and will make it available for on-demand viewing afterwards, in case you want to refer back to it or share it with others. The associated documents will be available at icas.com/events. Everyone in the webinar is automatically muted, so there is no need to be concerned about background noise wherever you are. We look forward to receiving your questions throughout the course of the webinar, and of course, we will try and get to as many as possible. Now, traditionally, and for example, as defined by the IFRS Foundation and described by the FRC, the primary audience for the annual report and accounts, including the management commentary and other reports, commonly included, are the company's investors. The principle to seek to ensure usefulness of the annual report and accounts is that the information they contain, beyond that specifically required by laws and regulations, should be material. That is, if omitting, misstating, or obscuring that information could reasonably be expected to influence the decisions that the primary users make on the basis of these reports. It is also very clear, however, and the recent publication of the IFRS Sustainability Disclosure Standards 1 and 2 are testament to this, that the sphere of interest is growing, with the increasing importance of sustainability reporting in all its aspects relevant to a fast expanding list of stakeholders, with very diverse interests, perspectives, and needs. Varying definitions of materiality have emerged. Financial, as adopted by the IFRS Foundation and the International Sustainability Standards Board, impact, as adopted by the GRI, Global Reporting Initiative, and double materiality, as adopted by EFRAG. Although helpfully, the GRI and EFRAG issued a joint statement of interoperability in the summer, confirming the adoption in the European Sustainability Reporting Standards, ESRS, of the same definition for impact materiality as GRI, embedded within the ESRS's requirement to adopt a double materiality approach. Notwithstanding these complexities, the high-level view, as highlighted in a frequently asked questions document published by the International Auditing and Assurance Standards Board at the end of October this year, is that materiality is a user-driven concept. That is, materiality is affected by perceptions of the information needs of intended users of the sustainability information, and that judgments about matters that are material to intended users of the sustainability information are based on a consideration of the common information needs of intended users as a group. Now, remove the word sustainability from this FAQ, as it was written from the specific perspective of how the concept of materiality applies to sustainability reporting and assurance, and the principle still remains. Material information is wholly relative to the needs of the users. The question, therefore, given the wide variety of perspectives and indeed information needs of the various readers of corporate reporting, is how do companies best identify the relevant material information to be included in their corporate reporting? The 2 presentations this morning seek to provide some analysis, guidance, and practical tips and considerations. In this regard, I'm delighted to be joined this morning by 4 speakers. Giovanna Michelon and Stuart Cooper, both professors of accounting at the University of Bristol, who have undertaken the research funded by ICAS. I should highlight that Stuart is in transit and is hoping to join up for the Q&A. and Michelle Cardwell and Caroline Konings, who are both project managers at the FRC Lab. Welcome all to today's webinar, and thank you very much for taking the time to come and speak to us today. I will now pass over to Giovanna to present the ICAS funded research.
Thank you very much, James. Good morning, everyone. Thank you, ICAS, for the kind invitation and, of course, for funding our project on materiality assessments in sustainability and financial reports. This is a joint work with colleagues from the University of Bristol, Stuart Cooper, as mentioned by James earlier, but also Shi Chen and Ziyi Guo, as well as Nicolas Garcia Torrea, who is from the University of Burgos in Spain. We're also particularly grateful to the ICAS Research Steering Group, Hilary Easton, Marie Gardner, and Yannis Talabutas for their guidance throughout the development of the project. The research has three key objectives. On one side, we conduct an empirical investigation of what firms disclose on their materiality assessment practices in the sustainability reports, and we explore whether the material topics that appear in sustainability reports are also discussed and reported upon in the strategic report and in the financial statement, so in the annual report. Then we proceed with an exploration of how preparers conduct their materiality assessment for sustainability reporting processes and how users and standard sector conceive and understand materiality, with a focus on the key challenges that the practice is currently facing. And then the third aim is essentially a reflection based on the empirical evidence that we have gathered about what are the connections between impact and financial materiality and how to further integrate and connect the materiality assessment processes across the sustainability and financial reporting domains. In terms of the literature, it's an emerging field of study in accounting, and essentially it points to materiality as being related to the decision making and decision usefulness, and as to the purpose assigned to corporate reporting, and in a sense to who are the audience, who are the users of such informations. As James was mentioning, there are three sort of right approaches to materiality when it comes to sustainability issues: impact materiality, financial materiality, and double materiality. And what the literature seems to suggest in a very succinct way, without spending too much time on it, is that in sustainability reporting, materiality is often an entity-specific process, and it's related to contingent factors such as the size of the firm, the industry it's in, and more widely, the reporting experience and maturity. So the literature has identified a variety of practices in terms of how firms conduct their materiality assessment, but also in terms of how transparent they are on these processes. The work that we do is an empirical analysis of 516 European firms for their reports published during 2021. We choose two different sectors, the financial sector and the so-called pollution-prone or environmental sensitive industry. Why these two sectors? Well, academic research has since long identified industry as an important explanatory variable for understanding sustainability reporting practices. In particular, the environmental sensitive industries are probably amongst the pioneers when it comes to sustainability reporting, due to the potentially relevant environmental impacts that they have due to their businesses. On the other side, the financial sector is being called upon by policymakers, especially in the European context, to facilitate and be part of the transition toward a sustainable economy. And they are also becoming more and more exposed to financial risks that arise from sustainability challenging, especially climate change. In terms of what the first type of evidence that we sort of collect from this investigation is that there are different practices in terms of where firms communicate sustainability information. Some produce standalone sustainability reports, other report this information in the annual report. We label them integrated, not necessarily because they follow the IR framework, but because they do not produce a separate standalone sustainability report, and they include ESG information in the annual report. The graph on the left shows that out of the 516 reports, there are 136, so 26% more or less, which do not provide any information about how they run the materiality assessments. And of the 380 that provide such information, about 59% also disclose what is known as a materiality matrix. That is an assessment process that considers more than one dimension, more than one decision point of view, if you wish, to identify which sustainability topics are deemed materials. Now, within these firms that provide the materiality matrix, our evidence suggests that there are essentially 3 points of view that firms adopt in their materiality assessment for sustainability reporting purpose. That of the firm itself, that of impact risk, and that of the stakeholders. And so from what you see in this table, is that the majority of the firms considers the point of view of the firm, together with the expectations and views that of the stakeholders, but also some they consider impact risk, and hence at first sight it seems they are somewhat aligning with what could be considered a double materiality approach. There are, however, a number of firms, about 23, that seem to follow only an impact materiality approach. And in 18 cases, although there is a matrix, this matrix is not sort of complete in the sense that one of the dimension that is being plotted is not used to cross over to different points of view, but rather to plot some other consideration, for example, the severity or magnitude of the risk. In terms of topics in sustainability reports, what comes out is that diversity, equity, and inclusion, employees, and information technologies are considered on average more material for the firm than they are for the stakeholder or for impact considerations. Whereas human rights, product responsibility, biodiversity, climate change, waste and water are on average more material for the stakeholders than they are for the firm. Now, in these slides, I'm sort of summarizing a bit the most common material sustainability topics that are being disclosed, not just in the sustainability report, but also how much these topics have then been discussed in the annual report. And what emerges is that employees and climate change are the most common material topics, followed by product responsibility. And there is more emphasis, or there is more disclosure around these topics in the sustainability report rather than in the annual report. Among governance information, the accountability and monitoring of the board of directors is the most material topic. And generally speaking, we notice that there is less emphasis given to the discussion of ESG information in the financial statements compared to what we see in the front end of the annual report, so the strategic report, or in the sustainability report. We also noted that on average, when a company is producing just one document, then there is more alignment in terms of how much disclosure is dedicated to the material topics in the front end and back end of the document, compared to what we see when we have companies that provide two different documents. Social topics are generally the ones that where we see more disalignment in terms of how much disclosure is being dedicated in the annual versus the sustainability report. And generally speaking, climate change is a topic that is discussed in both documents, whereas biodiversity, energy, and water are discussed and reported upon a lot more in the sustainability report. So up to here, the analysis of the reporting practices tell us that first, on average, firms do provide information about how they conduct materiality assessments, but there are still some that do not do so. Second, the approaches that consider more than one dimension and point of view are quite widespread. And third, perhaps not surprising, surprisingly, but still there, sustainability reports are the most common outlet to communicate sustainability information, even if there is a certain degree of alignment with what appeared in the annual report, especially in the sort of front end of the annual report compared to the financial statements. The next phase of our research was essentially a qualitative assessment of what are the processes and challenges that preparers face. And so here in this slide, I'm summarizing the interviews. We had 44 interviews with 19 preparers, but we also were able to interview users, not just investors, but also unions and regulators, as well as standard setters. And we were able to reach the three most important standard setters in the field and interview 3 different people from each of these standard setters. What did we find speaking with all of these interviewees? The first thing that is important to underline is that connectivity between sustainability and financial reporting is deemed quite important, especially for users. As you can see from the quote that comes from an asset manager, they speak about inseparability of the two. However, preparers told us that materiality assessment processes that are conducted for sustainability reporting purposes do not feed into the financial reporting process necessarily. And this lack of connection between the processes is due to various reasons. A traditionally different purpose assigned to sustainability and financial reports, and so a different new audience that they have in mind. Also the fact that there are higher levels of regulation and stricter auditing of financial reports, in a sense almost hinting to the fact that internal control systems of the firms are not necessarily ready to incorporate in financial reporting ESG information. There is an issue with the long-term horizon for certain sustainability issues, which makes their inclusion into the financial reporting process quite complex. And then a disconnection between the processes that are actually running within the firms when it comes to the preparation of these 2 types of reports, although we did meet some pioneers that are attempting to overcome this sort of more siloed approach. In terms of processes, interviews reveal that questionnaires and surveys and interviews are the key tools to engage with stakeholders in materiality assessment, especially when it comes to impact materiality. Some firms have started to include members of the top management team and investors in their materiality assessments to start identifying which topics may bear financial relevance. And the quote reported in these slides highlight that the points of view of the management is almost a 3rd dimension, so a new dimension compared to what companies were doing. And it's quite important to understand the financial implication of sustainability issues. Several challenges were identified through the interviews. Some of them are technical in nature. The interviewees highlighted that materiality thresholds are not easy to determine, and even if we sort of sampled a relatively small number of preparers, we have evidence that there is significant diversity in how firms approach the determination of thresholds. Some firms use quantitative scoring techniques, where others use policy negotiations. The quote from P4 that it's reported in the slides speaks of flexibility and subjectivity in determining what is going to make it the threshold, so that it is not easy to get it right. And with respect to this challenge, standard setters are aware of the lack of robustness in determining the thresholds, and they are aware of the need to provide more guidance on these specific issues. The last sort of technical challenge relates to the difficulties in finding panels of stakeholders who are experts of the issues that are called upon assessing. Essentially, firms reveal that some stakeholders do not have the relevant knowledge that is required to correctly assess the impacts. And so some firms refer to the need to adopt a science-based approach for certain sustainability issues. Perhaps not surprisingly, another set of challenges refers more broadly to the institutional environment firms are dealing with. There is a lack of clarity in the application of the materiality principle, but there is also fragmentation of the standard setting processes, so firms may be required to comply with sort of different guidance, and generally speaking, preparers were welcoming cooperation among the big players in this area. How to support connectivity between sustainability and financial reporting, and how to think about the interconnectedness between impact and financial materiality. So interviewees highlighted that the outside in and inside out relationships are the key links that drive interconnectedness between the two types of materiality, and topics that start as material from an impact perspective may become financially material over time. Others suggested that the lack of connectivity is often a governance problem, or we could say, to spin it more positively, it could be a governance solution, in the sense that in order to enhance connectivity, processes at the top management team as well as the board of directors level need to be adjusted to facilitate integration of sustainability consideration within the strategy formulation. And this is also somewhat what standard setters told us, in that they saw that most of the current governance arrangement, when there isn't this integration, may not be adequate to foster connectivity. Two more notions were mobilized, and in terms of the interviewees suggesting that they would facilitate connectivity between sustainability and financial reporting. And specifically, the two notions are those of risk and climate change. For example, in the financial sector, there are companies that are working to adapt their risk management systems within the unit so that the ESG considerations are embedded in decision making. Some other firms refer to risks in terms of reputation risk or risk arising from the supply chain that kind of makes ESG issues relevant for financial reporting processes. However, as we mentioned, the challenges associated with assessing impact materiality due, for example, to the lack of expertise of the stakeholder panels or the long-term horizons may hinder the integration and connectivity. To summarize, it seems companies are adopting what is known as a double materiality approach, but this is not necessarily what the EFRAG has in mind. EFRAG speaks of double materiality as union of the financial and impact materiality, not as an intersection, whereas most companies were intersecting the two. We do not find overwhelming evidence of discrepancies in terms of the relevance of the sustainability topics that are reporting in sustainability reports vis-a-vis the annual report. But the interviews revealed that there are no systematic approaches to grant connectivity, and so the assessment processes are often siloed. Regulation seems to be pushing for more integration, and this is particularly true for the financial sectors. Challenges are technical and institutional, but also cultural, and then they will require different action to be dealt with. Overall, it seems that risk, corporate governance, and climate change are useful notions to enhance interconnectedness. And in a sort of a reflection that we've made over this finding is that it seems the materiality solely conceived as a principle for decision usefulness could bear several challenges. Users of sustainability information are not confined to investors, and therefore there are different approaches to identifying the most relevant stakeholders. Users may have different needs, which inform their decision, and hence what is useful information in the context of different decisions cannot be univocally identified. The dynamic way in which sustainability issues may become relevant for the business model and performance of the firm is uncertain and implies a time horizon for assessing the impacts vis-a-vis the financial implications are not aligned. And this implies in turn that the underlying assumption for managing and quantified risk are hard to determine. So sustainability impacts may continue to be treated as uncertainty rather than risk until there are other circumstances that make preparing users more aware and knowledgeable about the probabilities of the potential outcomes. For example, regulatory action. In sustainability reporting, information is relevant if it informs about corporate impacts in the wider context of sustainable development. And the further purpose of reporting is not just to inform decision, but perhaps also to provide a transparent account of how an organization contributes positively or negatively to sustainable development. To conclude, materiality assessment should start from evaluating impact materiality to assess what of these relevant impacts may become material from a financial perspective. Companies need to foster cooperation between their sustainability and financial reporting teams to enable connectivity in between the reporting arenas so that the identification of impact issues feed into the financial reporting process. There is a centrality of the stakeholder engagement process for the purpose of materiality assessment with the challenges that we have discussed. Implication for standard setters are essentially the idea that the more convergence there will be across different standard setters, probably the better. This is what a lot of the preparers were wishing for. There should also be potentially more clear guidance on how materiality is understood and the process the organization should establish to carry out this materiality assessment, especially given the challenges that the currently preparers are facing, such as the determination of threshold or the quantification of impacts. And then, of course, it looks like regulation is something that has been fostering or enhancing, if you wish, the interconnectedness between sustainability and financial reporting. And with that, I will stop here. Thank you very much. James, I'm going to pass it back to you.
Thanks very much, Giovanna, for that very insightful presentation. I will now pass over to Michelle and Kathleen from the FRC Lab to give us their presentation. Thank you.
Great, thanks, James, and thanks, Gio. It's been really fascinating hearing about your research on materiality, in particular around how companies can start to think about better connecting financial and sustainability materiality, as that really fits in with what our materiality mindset help to achieve. We're really happy to speak with you all today about the recent work that the FRC Lab has done on materiality, which we're calling applying a materiality mindset. So what are the issues? So materiality, it's a foundational concept in corporate reporting. All of us would have learned about it in our early accounting exams quite early on. And it's quite at the heart of what we do from a corporate reporting point of view. And, when you think about it simply, it's really about deciding what information is important enough to include or exclude when you're reporting. Now, I mean, that sounds really simple, but I don't think we'd all be here today in this webinar discussing materiality if in practice assessing materiality was that simple or straightforward. It's quite difficult, actually, because it's subjective. It requires all of us to use judgment, to think about what issues are really, ranked out and more important. And this has really gotten much more difficult, I think, in recent times. We're in the period of a bit of change in terms of corporate reporting. We're seeing increasing calls from investors and other stakeholders to provide more information on sustainability and other non-financial reporting topics. We're seeing new standards being drafted and old ones that are being considered for updating. And so this period of change and sort of thinking about new and change is difficult for preparers. Preparers, you're considering what information is material for non-financial information. This can be quite challenging. And we've seen with companies that often there can be sort of feeling that it's easier to include more information rather than tailoring it more specifically. And in contrast, we're hearing from at the lab often from investors where they say, hey, we're worried, reports have increased in length, complexity, and maybe not with providing better information in all cases. There's a sort of worry that potentially material information is either left out or it's being obscured by an excess of information. So with that in mind, the FRC lab, we decided we would explore materiality further in practice. So how companies are thinking about materiality assessments now, sort of issues, challenges, and lessons that they might be able to provide us from their own work, as well as what investors want to know, really getting to the heart, as James mentioned, materiality is a concept based around users. So what is it that investors want to know? And how could we distill this into something that could be practical and useful for companies to be able to communicate clearly and compellingly in their annual reports? So a little bit about what we did over the past year as part of this project. We've been doing a lot of research into what people are doing, and we've been doing a lot of engaging, a lot of conversations with companies, with different stakeholders such as investors, preparers, advisors, all sorts across the financial reporting and the corporate reporting ecosystem. And we've done a lot of interviews, 50 in total over the year, and quite a few roundtables where we worked on understanding the issues in depth. And what we've done is produce a series of short reports that are on the FRC's webpage, which we've got the titles there on the screen for you. We see it as a sort of toolkit to help you sort of think about a materiality mindset. And today, Carleen and I, we are going to explore these topics at a high level with you today. So the first thing we want to start with is really about the heart and the user of the report. So thinking about investor needs and decision making. And, boards of management, they understand their business and the value drivers in depth. But, when they're reporting, they do need to think about those user needs with it. And, when you stand back and you look at reporting requirements, it's all underpinned by materiality. In the UK context, these reporting standards typically will define materiality in relation to investor decision making. And when you look back at that, this is really just to generalize this or to keep a really high level definition. This is typically when information is material when you omit, obscure, or misstate it. And that could have an impact on an investor's decision making. So whether they decide to invest or sell, increase, decrease holdings and shares, that sort of thing, or for example, in lending decisions as well. So for us, this seemed like quite a crucial starting point to think about the investor needs when we were thinking about how companies can get better about thinking about materiality. Now, investors, they are not homogenous. This is a big challenge in terms of it. They have different investment strategies and they have different risk appetites, and this can change the way they act. So you can't really talk about a single archetypal investor, but when you think about their objective, which is, to make a return on their investment, it is possible to identify some common questions or core information needs. So in our conversations with investors, we sort of said, okay, well, where's your typical starting point when you're looking at using an annual report? What are you looking for? How do you think through, what's the sort of things that are helpful? And this is really key for them, especially in initial investment decisions. So when they're getting to know a company, the annual report plays a key role. What they told us is really at the heart of when they're going to make an investment decision, they want to get an understanding of the company and its business model. So what it does and how it generates value. So what services or goods is it producing? Where is it operating? What its competitive advantage? That sort of thing. And really, they want to understand it from the board and management's perspective. This is what they really value, insights into what they're thinking about. So they want to understand management strategy for the future. So they're performing well now, but what's next? Is it going to continue to generate a return that's stable? Is it a growth? Is it expansion? These sorts of things. And they're aware and obviously want companies to balance commercial sensitivities, but they sort of want an understanding of potential future returns. Are you going to be entering a new market? Are you generating new products? Growth strategies, those sorts of things at a high level that gives them an understanding of where it's going. But obviously, with the future, they're also interested in understanding risks that the company might face along the way. And one of the investors told us, they want to know what keeps the directors awake at night. So they're interested really in understanding the sort of specific focus risks that companies, boards are thinking about, and how, what that says about how they're planning on mitigating. Because what they're looking for is this insight about how they're thinking. And what's really key about this is that view is holistic. So how the business model and the future strategy and risks are thought about in an integrated and connected manner. And sustainability is increasingly a part of that to investors. Investors tell us that if a company, for example, has reputational damage due to some sort of sustainability issue, or potentially there's an increased regulation costs or work, or even commitments for net zero. They want to understand, because that changes the cost of capital, it changes, the cost of running the business. So they're interested in understanding that as it integrates into the business model, not as a separate sort of concept. And that sort of view is really, really key for seeing how things interconnect and balance with each other. So that brings us into our next point, which I'm going to pass over to my colleague Carleen, about how companies think about this holistically.
Yeah, so despite what Michelle just explained about investors wanting to get that holistic view, what we heard from many companies that we spoke to is that they look at materiality through three separate lenses. So first of all, there's the traditional quantitative financial view. So most companies have these monetary thresholds, mainly for to help them decide when to correct errors and when to disclose transactions in their accounts. And these thresholds are often the same or slightly lower than what their auditor uses. And that would be a figure that's like a percentage of profit before tax or net assets. So that's the sort of classic quantitative approach. Then in addition to that, many reporting frameworks like IFRS also have the concept of qualitative factors that can make something material. And the companies we spoke to rarely had any formal process to identify what are those qualitative factors. Instead, they had sort of a gut feeling when something was material because of qualitative reasons. And then the third lens is the sustainability lens. So we found many companies did a separate sustainability materiality assessment. They often, as Giovanna explained, interview a range of external stakeholders. Many of them are using a double materiality approach, and this is often together with or with the help of an external advisor to support companies in these assessments. And then often they'll prepare a materiality matrix that you'll see in sustainability and annual reports. And while many of the companies that we spoke to seem to keep these lenses separate, some companies said that they've found it very helpful to bring these together instead and to better meet those investors' demands for a more holistic view. So the second sort of component of our project report talks about how companies that we spoke to, how they are managing to bring those three lenses together and take a more holistic approach. So it's sort of a list of tips for companies. So one of the central points that we heard is that it's key to get the right people together, whether that's through the right sort of cross-organizational working groups, the right governance arrangements, the right reporting lines, to make sure really that you can gather a wide range of views across the business on what really matters. And then that cross-organizational materiality assessment will probably give you a very long list of topics that are important to the business. But then the next question is, how do you really prioritize these topics and narrow them down to a shorter list of key issues? Because we heard that investors want to understand what are the issues that the company is really focusing on in terms of what is it spending time and resources on, and they don't find sort of kitchen sink approach very helpful. For example, we heard from some investors that they find it particularly worrying when they see a very long list of principal risks, because then it seems like the board might be sort of spreading itself a bit thinly, and it's better to focus on a few key topics. And so the report contains some tips for companies to help them in making this sort of holistic assessments help them challenge themselves and hone in on those priorities, document their approach, and also horizon scan to keep on top of changes in material issues over time. And we also have some videos on the different pages that give you some insights into how companies are approaching this themselves. And then the third piece of the report, so assessing materiality is the first step, but the actual annual report drafting process and sort of putting pen to paper brings its own challenges. And that's what this third section focuses on. So in the annual reporting process, you'll often have many teams contributing parts to the report who want to tell their own story. And then how do you manage that process so that you end up with a concise report that has clear and consistent messaging throughout, while also meeting legal and regulatory obligations? And so again, we gathered tips from the companies that we spoke to throughout the project. This is not intended to be a complete list in any way. It's just a collection of smaller and bigger actions that companies might find helpful. And I'll highlight just a few that are on this slide. So for example, we heard that getting senior buy-in can be incredibly helpful to keep your report concise. So one company told us their chief executive set them a target of, I want us to reduce our annual report in total by 25% in length. And that made it much easier for the corporate reporting team to then ask the different contributing teams to keep their sections concise. Several companies also recommended taking sort of an explicit step back once you have a draft of the report to make sure it works as a package. And some companies find it helpful to incorporate that step back into their fair, balanced and understandable assessment, which is already on the board agenda for those applying the corporate governance code. And then some companies also suggested identifying information that is currently in your annual report, but that isn't really required to be there and is actually better suited for a different format or medium, like a video or an animation on your website. For example, case studies might be quite a type of information that might be better presented on your website in that kind of way. So with that, I'll hand back to Michelle for wrapping up.
Thanks, Caroline. And we really hope you'll have found those tips really helpful and useful for you. Assessing materiality, it's not an easy task, but it's a worthwhile one to do. And I think by taking this holistic view of the company, its strategy, operations, and management and the board are going to be able to identify issues that are not only of interest to investors, but help them run the business more effectively. And sustainability, in one investor, it's really they want to understand the business. One of the investors told us, this is all about building conviction. What I want is for it to tell me what management believes is most important, and then I'll decide whether if you believe it or not with them. So this is really valuable, and we hear that well-articulated business models, in particular with it, can help increase valuation. We're actually doing a piece of work in the lab right now on business models. So if you check out our pages on that, it'll be useful. I've popped up now the detail of all the web pages you can access the reports and have a look. Just to say as well, given the importance of materiality for corporate reporting, as well as the challenges that people are faced, the lab's going to be continuing to work on this area over the coming year. And if you'd like to be involved or share your views, do just get in touch with us at the FRC lab at frc.org.uk, and we'd be very happy to chat with you further on it. I'll pass back over to you now, James.
Thanks very much, Michelle and Caroline, for another very insightful presentation. Great to see the work the FRC lab are doing. We'll now move to questions from the audience. And the first one, and I'm going to put this to Stuart, from the audience is it possible to incorporate the independent assurer's perspective on how materiality is analysed in sustainability reports and integrated reports?
Thanks, James, and I apologise if the background noise is bad. Well, I think it certainly is possible. There's two elements to this. It's not something we looked at in the empirical section of our study, but certainly in the interviews, a number of interviewees were keen to see the role of assurance. And particularly, I think there is a role that assurance can play in two ways for this. One in terms of assuring the process. So looking actually at the materiality assessment process that organizations are using to see if they're appropriate and robust, but then also to look at the outcomes of the process as well. And I suppose one of the things that was coming through in some of the interviews was a concern about how we have an auditor for the financial statements that may or may not be consistent with who is assuring the sustainability statement as well. So there might be, again, a lack of connection there between those two elements of the assurance. And again, it was a small number of interviews that talked about this, but there was a keenness to see some alignment there as well, to see how that could be moved. And obviously in the EU, we do have a move towards requiring limited assurance of sustainability information, where again, materiality assessment should be part of that, I would imagine.
Thanks very much, Stuart, and great to see connectivity coming in there again. You know, in a world where we are now so connected, it's really quite incredible that connectivity seems to be such a major issue when it comes to corporate reporting, but hopefully something that we will progress as time goes on. My next question, this is for Giovanna and Stuart. The CFO, as well as governance interactions between senior management, the audit committee and the sustainability committee, are seen as a driving force behind the interconnectedness in reporting. What's a critical success factor those actors' expertise in relation to sustainability, or more a function of their position?
Stuart, are you happy for me to answer this one? Okay. So I think it's more, I think what comes out from the interviews is more a function of the position. Although there were some examples from the interviews where the CEO's passion or understanding of sustainability issues did provide an important force, an important impetus to a more connected approach to governance and reporting. Somehow it's the usual champion for sustainability within the firm that fosters integration and connectedness.
Thanks very much, Giovanna. Now, a question for Michelle or Caroline. It's really about the qualitative factors of materiality and the sort of gut feeling. Did you get any more insights into beyond the gut feeling as to how preparers are going about looking at the qualitative aspects of materiality?
Do you want me to? I can answer this one, Carleen, if you want. So I think from a qualitative point of view, you know, it's so quantitative is quite well understood. Just, you know, from a framing, you see it often in controls and sort of has formalized elements to it. But a qualitative assessments from a reporting point of view are often sort of, well, we know this important thing has happened in the year. Often companies, you know, you have that in the boards and management. They really understand their business, so they have an idea generally. But as far as the sort of process or sort of weighing across or gatherings, sometimes companies aren't always doing that. We did find that companies who looked at it from a fair, balanced, and understandable perspective, they sort of stood back and looked at it. That was a stronger sort of control around it, or a process more formalized on qualitative assessments that was quite useful for them to frame materiality in.
And maybe to add to that, we heard some examples in some industries that was a little bit more formalized what was qualitatively material. For example, we spoke to a few pharmaceutical companies and they had quite a clear idea and documented idea in their mind of what types of announcements about developments in their pipeline they would consider material and would be disclosing. So it varied a bit, but yeah, that was one of the rare examples of a more formalized process.
Thanks very much, both. That's great. My next question, I'll go to Stuart on this first. In relation to the assessment of materiality based on risk and considering the difference between risk and uncertainty, for which it is difficult to assess the probabilities associated with different outcomes and therefore hard to estimate risk. This is particularly the case for less quantifiable ESG dimensions such as biodiversity, for example. Does considering materiality through the prism of risk still lead to the correct conclusions?
Yes, thanks. So this is really a question that we specifically asked interviewees as part of our study, because we were very interested in how would tackle this, where there's certain issues such as climate change, where we think we understand the risks in a much stronger way, and then we have other issues, as you say, biodiversity, where this is a lot less certain. And I think it's fair to say that the sense we got, I mean, of course, there's always differences, is that when there is more uncertainty, when the time horizon is longer, companies do find it much more difficult to know how to address that within their reporting. And there is a tendency that maybe, therefore, once it is not easily quantifiable in a risk sense, that these issues could be sort of left on the sideline for the near term, and it might only become as they be and the risks become more quantifiable, that they would become a stronger part of the reporting and disclosure of organizations. So yes, very much around uncertainty being a challenge and long-term time horizons being a challenge for organizations.
Thanks very much, Stuart. A question for both teams. Did the size of the organization have a major impact on where they are in relation to this journey in materiality? Could I go to the FRC lab in this first?
Sure. Yeah. I can jump in, and Carleen jump in if there's anything to add to as well. I think we would definitely see, obviously, larger companies are probably a bit further in terms of thinking about sustainability. But what I think you really see a bit more of differences where you've got a company where it's fairly existential, or they've already got, for example, oil and gas. They might be thinking about it a bit more connected directly into the business operations already. You would tend to see, those sorts of things where they're thinking about it. But I think, smaller companies are starting to realize that impact. And I think hopefully, we'll start to think about more holistically, because it's quite important. There are demands that will come through across supply chains as well on information that are increasingly important. I don't know.
Thank you very much, Michelle. Sorry, Carleen, did you want to add something? Or?
Oh, thank you.
No. Giovanna, do you have anything on this one?
So we haven't run any sort of statistical stats to say sort of whether size is sort of a determinant in a statistical way, but definitely I think what emerged more from the interviews was the maturity of the firm with sustainability reporting. That was what's driving somewhat the different practices that we saw, more than the size. Now, it could be that firms that are larger are the ones that are more mature because they started a long time ago, of course. But I wouldn't be able to sort of respond to that in a definite way. I would have to go back to the data, the quant data to come back. But I think the maturity of the process was something that came out quite a lot.
Thanks very much, Giovanna. And another question that's come in from the audience, from either yourself or Stuart. Where there are two reports produced, did the research project check that there was adequate signposting between the two reports, and where there was there any crossover between and the reports consistent?
I'll take this one, Stuart, if that is okay with you. Yeah. We didn't specifically check for cross-posting, signposting between the two reports. The approach we adopted, given the large number of reports that we analyzed, was more of essentially developing a dictionary for each sustainability topic that we encountered, and use this dictionary to check how much information was then being reported in the annual report, whether in the front end or in the back end. So we don't get into the details of the signposting between the two different reports, no.
Okay, so this is a final question. Whilst there will naturally be large differences in the maturity of companies and their approach to assessing materiality for sustainability and financial reporting, was there a feel for an average level of preparedness, sophistication, and therefore interconnectedness? Giovanna, are you able to give any insights in that one?
I wonder whether Stuart wants to take this one.
Okay.
Thanks, Gio. Yeah, I mean, absolutely. As the question says, there's definitely a large range of differences in the maturity that Giovanna was just taking, which is driving, some real differences in how prepared some organisations are. I think our sense is that, the more mature the processes are for materiality assessment, the better prepared those organisations are. But I still think that there's a level of sophistication missing in terms of really thinking about the interconnectedness. And that's where I think a lot of the work is, and certainly our finding around how there is still quite a siloed approach in many organizations was an issue between this interconnection where that was failing. And so I think a big step forward will be closer links between, for example, the financial reporting team and the sustainability team, but also thinking more about, as organizations get more used to thinking through a double materiality approach and how those two are interacted and interconnect as well. There's still some way to go, but of course there are some organizations that are further along this journey than others.
In fact, I lied. We have one final question that's just come in, which I think was of value to the audience. I will give this to both teams. What is the best piece of advice you would give for companies at the early stage in their journey in making materiality assessments for sustainability issues? And could I go to the FRC team first, please?
Yeah, certainly. I think some of the points that Carleen touched on when she was talking about the holistic approach are really key. I think if you're starting out, don't start out alone. Try to work across the organization to take a holistic view and understand the issues. If you start connecting from the very beginning, then you won't have to join up later and you'll learn a lot more as you go. Carleen, I don't know if you want to add.
In our report, we also talk a bit about how you can leverage existing processes that you have that you maybe traditionally haven't thought of as a materiality assessment, but that you would still have throughout your operations, and sort of leveraging the existing processes and not necessarily starting from scratch, I think is also a good starting point.
Thank you. Giovanna or Stuart, anything you would like to add?
I think Stuart kind of mentioned in his last answer, I guess the connecting the sustainability and the financial reporting teams, it's probably a good start, and not just for the reporting, but more generally. And then, as I was mentioning during the presentation, it is a bit of a governance issue. And that means that sort of the highest levels of the organization, there must be some integration that starts from possibly a strategy formulation perspective, but also goes into the design and the adequacy of the internal control systems that allow the sort of two type of reporting to actually speak to each other.
Thanks very much, Giovanna.
So just actually probably bad timing. I think there's an announcement going in the background. I was just going to add, one of the things that we did identify was how it was felt that organizations would be best served to think about impact materiality as a first step before then moving on to think about financial materiality. And another part would be for organizations to really think about what evidence they would be able to gather for impact materiality if they're going to do stakeholder engagement. Then who would be knowledgeable and appropriate stakeholders to be engaging with, and how would that then inform their process? I think that was all I wanted to add. Thank you.
Thanks very much, Stuart. We got there just in time for any further announcements. Well, we are almost out of time. So thank you very much to all our speakers for joining us this morning. A lot of food for thought and some practical advice too. I hope that you will have found this webinar. The FRC Lab is published at the link on your screen, and the ICAS report will be published shortly and will be available on icas.com/professional resources in the research section of the website. We also have further events coming up, and they're listed there on the screen at the moment. So if you can get along, please do so. And finally, it only leaves me once again to thank our speakers and, of course, you, the audience, for joining the webinar today. I do hope that the webinar has been helpful to you. It would be great to receive your feedback on this webinar and to hear any future topics that you would like us to cover. So thanks for joining us, and until the next time, goodbye.